The bull is getting tired. So as we all know, that this bull market has been very narrow, frankly, since the banking crisis in 2023. What we can see, obviously, at least from an index perspective, this is not bearish. It's descriptive. It's describing what we all know to be a very narrow bull market. Bull market nonetheless, it's just narrow. Having said that, the tactical concerns that I've been highlighting for a couple months now, they continue to worsen, and I've got some pretty interesting charts to show. So I thought it would be worth. I took a look at technology last month, and I'm going to do it again this month because it's obviously a very important sector. As I've said before, it surprises most people to know that it's not the number one sector in terms of equally weighted at the sector level. We still have industrials, financials, and materials are ahead of technology. So technology is still in there; it's still a leader, but it's not number one. Before I say anything about the breadth of the sector, you have to look at this first, right? So as long as this is true, you at least can't be bearish on the sector ETF. Now, at the individual stock level, once you drill down beneath the surface, that is an entirely different question. Even there, I don't think that necessarily matters yet. So we can identify a bearish trend at the sector level, and you can clearly see that's not the case. So what I'm, again, putting out here are things that are very important to watch going forward, because if they do continue to deteriorate as they have been, we could see ultimately this XLK break its own trend as well, which will change our first question, which is, what regime are we in? That'll change from sideways to up to sideways to down. Here's what's different about this breakout. So when you look at the breakout that happened after the second and third quarter, I guess, correction of 2023, when you broke out of that correction, you had a very strong breadth thrust. So this is showing you the percentage of stocks in the XLK that are above their 20 and 50-day moving average. So we get a very strong, robust reading, which you can see in these other periods in the prior part of the year were also conducive of higher prices, sustained higher prices, because there was a lot of strong breadth beneath. Now, when we look at this base breakout that just happened, we don't see nearly as strong of breadth as we saw in the last breakout and in other breakouts as well. In fact, if you measure the strongest point of breadth during the last breakout to where we are now, it's actually in a downtrend. So this is again just showing us that the breadth of even one of the strongest sectors is just continuing to thin out more and more, and just getting less supportive of sustained higher prices. So when we do look at this through the lens of our own modeling process, you can't ignore the fact that we see what we see here. I mean, it's pretty robust, very strong, powerful breakout. But we also can see that the sector has taken on structural water as well. We have both of these timeframes are showing very weak price structure. The downtrend is the largest bucket in the tech sector on the monthly chart, on the weekly chart. It is kind of something we're going to need to follow going forward, because this robust, at least from a momentum perspective, move out of this base, which gives the appearance of being a very healthy market, is actually quite different when you dig beneath the surface and look at the actual stocks that are in this index, and you find that there's quite a few more stocks in a downtrend. Here's just to bring this all home, I guess, in terms of how bad it actually has been since the last monthly motor checkup. So since the last checkup, which was May 24th, the Nasdaq is up 5% and the SPY is up 3.3%. So again, remember, these are cap weighted indices, heavily weighted by the Mag 7 company. So what they do essentially is what happens to the indexes as well. But look at this, the average rate of change of the stocks within the various sectors. Every one of them is down since May 24th. I just say it again, we know what bull markets look like. This is not what a traditional robust bull market looks like. In robust bull markets, your biggest risk is that you don't own the leadership. This is getting closer and closer to the environment potentially where we need to be very mindful that we're changing regimes from sideways to up to sideways to down. A lot has happened since we shared that video with our clients in June. As the trend continued higher, more and more divergences appeared, this time between higher price but lower momentum. These divergences historically warn of waning strength in the trend and can lead to some pretty nasty corrections along the way. And of course, this time has proven to be no different. I mentioned that this trend line needed to be broken to really be concerned, and as we can see, it has indeed given way. At the same time, over the past couple of months, the tech sector has continued to deteriorate in our momentum ranks. Additionally, the very defensive utility sector has worked its way into the number 2 spot. Clearly, there are a lot of questions about the future direction of the market. If you'd like to receive our research on a timely basis, visit our site to sign up for a 1-month trial of the Motor Research service. See the link in the description below.